let's talk about something called an annuity. Annuity. There are two types of annuities. Ordinary and what we refer to as an annuity due. Okay, first let me just go over the basics of what is an annuity. We talked about single lump sums and how we can look at values in time, either the future or the present value when it's just one time, one lump sum, one payment. $100 in the future, or if we do something with $100 now, what would it be in the future? Okay, one time, one payment, or one receipt. An annuity are multiple payments, but something specific for an annuity is it must be equal payments. So an equal really means two things. First, it has to be the same dollar value each time. So I'll give you some examples in a minute, but let's just say you're talking about, $100 every month. Okay? Well, that's an annuity. It's the same amount, but it's also the same span of time. So you have to have the same lapse in time. It can't be that you're looking at something where you get paid $100 in a month, but then you get $100 5 months from now, but then you get it again 2 months from that. That's not an annuity. An annuity is I get paid $100 every month for the next 10 years. That's equal annual payments. Okay, one way to state it. But they're equal in dollar value and they're the same amount of time in between each payment. So that's what we're talking about when we say an annuity. Have you ever seen those commercials where they're singing, oh gosh, I thought I'd never forget those. Anyway, they have like the bus and everybody's singing about your annuity now, get your, yeah, 877 cash now. See, I know I can remember. Anyway, I digress. That's an annuity payment. So you can see annuities in real life in multiple different ways, and we'll talk about some examples as well. Two kinds of annuities, though. Again, this can be money you're getting or money you're paying. The first is an ordinary annuity. An ordinary annuity is where you're either making payments or you're receiving money. Sometimes these are referred to as rents when you're the one getting the money. And that's when these are made at the end of the period, so the end of the month or the end of the year. So for an ordinary annuity, there's actually no interest on the first period or the first payment or the first receipt or the first rent because it occurred at the end of the period. So there's no interest calculation for that one because it was the end. So there's going to be one less than for the annuity due when you talk about future value, because if you push it out to the future, as you'll see in a minute, you're going to have one less interest calculation on an ordinary annuity than you would have on an annuity due. Annuity due, the only difference is the timing. So now instead of at the end of the period, you're looking at payments or receipts or rents at the beginning of a period. So the first of the month or the first of the year instead of at the end. So now you have one more than the ordinary annuity for future value, but you actually have one less for present value. When you run it the opposite way, then ordinary annuity is going to have one more, okay, than the annuity due. But annuity due means that it's at the beginning of the period, and ordinary annuity means it's at the end of the period, okay? So difference in how the interest will be calculated. Now when we did our single sum, I gave you an example of you have $10,000 and you're going to invest it and how much would be there. Well, let's do a future value calculation for this, but let's say that maybe you don't have $10,000 just to plop somewhere, okay? And we're going to do an annuity. So let's say that we're looking at an ordinary annuity. So at the end of, let's say we do it annually. So at the end of each year, we're going to put $100 in our savings account. Okay? Every year we stick $100 in there. Okay? And let's just keep on using, I've used 6%. Let's keep using just the 6%. That's arbitrary, but it wouldn't be if you were doing this in business. That would be an actual valid number. But let's assume that we can receive 6% on our savings or our investments. Okay? So I want to know what would be the value of that in a year. Let's do that so you can see something about this. Okay, if it's an ordinary annuity, what did we say? We make that at what? The beginning or the end of the year? I know I can't give you an answer, but I can imagine you're all extremely participative. This one is at the end. So how much interest would we earn on that $100 if it's an ordinary annuity? Should be no interest because we made it at the very end of the year, so no interest could be earned on that because it's only been there at the end of the year. Okay? But to double check this and prove this, we want to go find a factor out of our factor tables. So we're doing future value, right? We put it in today. How much is it going to be worth after that first year, which kind of is the first year for that. So future value of an ordinary annuity. Okay? So when we look at future value of an ordinary annuity, then we're going to, again, look for this 6% because we're compounding this annually. And it's been one period. So if you look at 6%, one period, you're going to find that that future value factor equals 1.0000. Because again, it hasn't had time to actually earn any interest. So you multiply that by your $100, and that's going to give you $100 for, I'm just going to put for year one. Okay? First year, you just made the deposit on December 31st. Hadn't earned any interest. You just got $100 there. All right. So let's take this out to 5 years. Let's look at 5 years. Okay, so again, what's our factor? We need to go find the factor. Well, it's compounding annually, so you use the 6%, and look that up in the tables, and we've compounded that interest 5 times if it's compounded annually. So we want to look at the n of 5 and the 6%, and you should find my factor, 6%, 5, all right, you should see a factor of, didn't write my factor down, okay, 5.63709. And please walk through these with me so that you know where to find these. So, look through the tables, make sure you know where these come from. And, hey, you never know. I might get them wrong sometimes. You can always call me on it. And please do if you see an error so I can fix it. So at 5 years, that's my factor. We multiply that by the $100 I'm putting in each year. So that gives me a total of $563.71. Okay? I mean, it's not much, but it's better than the $500 you'd have without the compounding interest. Without interest at all, I guess. You've gotten $63.71. So we can keep going. Let's do a few more just so you're comfortable with finding the factors. Let's do 10 years and then let's push it to 20 as well, just for a comparison. Okay? At 10 years, we're going to go to, all right, 6% annually. So we've done that 10 times. So you want an n of 10, the 6%. So you've got, should find the factor of 13.18079. And I'm going to go ahead and look up this factor while I'm doing factors. 20 years, 6% annually. So we've done that 20 times. 20 times, or 20 is the n, 6%, a column. So that should be a factor of 36.78559. Multiply this by our $100 that we put in each year. At the end of 10 years, you would have 131808 rounded. And at the end of 20, you'd have 367856. Okay? Now, what if you did this and, oh, let's just draw. I'll get a new space. Let's get a new page. What if you, instead of doing $100 a year, let's say you did it twice a year. So let's do the same $100, but now we do it semi-annually. And the interest compounds semi-annually as well. Again, we're still going to have the 6% stated rate of interest, which is a per annum figure. Okay, so let's do the same time frame. Let's do 1 year, 5 years, 10 years, and 20 years, just like we did before. You can see how it'll be a little bit different. Of course, now you're putting in more money. You're putting in $200 a year in your own amount, and then we have the interest on top of that. Okay, so after 1 year, Okay, again, 6% is my interest, but we're doing this semi-annually. It's been 1 year. So in the table, still looking at future value of an annuity, of an ordinary annuity. You're not going to go to the 6% column though, because we're not doing this once a year anymore. We're doing it semi-annually. So what do I need to do with this 6? I need to multiply that by 6/12 or divide it in half. Okay, because this is for 12/12 that 6% is. I just want 6/12 because each time we calculate it's only for 6/12 of the year. So I need to look up 3% in there. So over here on my column, you should be looking at 3% column, and then the N for each of these. Okay, for 1 year, how many times did we calculate interest? How many times did we put money in on or pay the annuity? We did that 2 times. For 5 years, how many times did we do that? We did it 10 times. For 10 years, we did it 20. 20 years, we did it 40 times. Okay? Hopefully you're following me. So for each of these, okay, the annuity is still $100. Don't put, and this gets confusing a little bit, because you say, wait a minute, the first year I actually put in $200, right? I did it twice. You're right. But the factors that we're getting out of the table, that's why we're changing this number over here. The factors know that. That's what they're based on. So we're just saying, what is the annuity itself? Well, it's $100 twice a year. So the $100 is what we're basing this. The factor takes care of the issue of that we've done it multiple times. Okay? So don't put 200 here and 500 here and yeah, what? Not 500, but okay, you get the point. Don't put that. Okay? So, we're going to multiply by our factors. So if you go and look these up again, 3% and the appropriate ends that we just talked through, you should find a factor of 2.03000, a factor of 11.46338, a factor of 26.87037, and a factor of 75 point, I think that's a 4. Where did my factor go? Sorry. Yes, okay. 40126. Now we just do our calculation for these, and you should, so we have 203. So we did earn a little bit of interest, even though this was an ordinary annuity. The first one didn't earn, but the second $100 payment is what earned that $3. So instead of just having 200 here, you have 203 because of the second part, since it was semi-annually. Here you've got 1146.34, 2687.04, and 7540.13. And I'm sorry these ends don't match up. I write crooked. That's what they relate to. Told you I write on the slant. Kind of goes uphill. Okay? Now let me show you one more thing that's fun. And this one you can't do with the tables that you might have access to with our course materials. You could pull it online. Or you can use a financial calculator, whether an electronic one, a free one online you can find, or you can use a physical financial calculator. Now, you're not going to be using this on an exam with me, but they're very useful and they can come in handy for real life. You could impress possibly a lot of bankers or car salesmen or some other folks, or maybe realtors, with your knowledge of time value and ability to calculate payments and annuities and amortization schedules and all kinds of fun things that you can do with a financial calculator. They're relatively cheap and pretty easy to use. They're like 20 bucks. I have an HB, that's good. I have an HP 10B, I think it's like a 10B2 that I use. It's very easy, and it has, again, if you want some more information on using the financial calculator to double check some of these, I can tell you how to do that. It has all the function buttons at the top that calculate time value of money calculations. Once you put in some of them, then you hit one, it calculates the one you're missing. So I use that. Again, you might not be able to pull these, so I'm not going to list factors with this, but I just want to show you one more example with how this would work. So let's say that instead of $100 annually or semi-annually, you did $100 monthly. Okay? Every month you put $100 into your savings or your investment, whatever it was. All right, so I'm going to give you the same things after 1 year, after 5 years, after 10 years, and then after 20 years. Okay, so after the first year, if you put $100 in every month, and again, I'll assume this 6% that we've kept with, then you would have $1233.56, and I'm also assuming this is an ordinary annuity. Okay. After 5 years, and you can see, I mean, 100 times 12, that's $1,200. So you got 33 bucks that you earned that year. So it's a little low. Okay. At year 5, you're up to $69.77. Again, this isn't like the $10,000 example I gave you earlier. You've really put in $100 a month for 5 years, so you need to know how much of that is your own principal. There's $16,387.93 after 10 years. And I'll give you a good comparison on 20. After 20, it's $46,204.09. Now, you're not a millionaire, but you've put in $100 a month for 20 years. So how much have you actually put in yourself? I'll give you a second. I'll let you do the calculation. I'll give you a little bit of silence while you do it. What do you think? 100 in a month, and I'll do it too. Make sure. And that's for 20 years. Yep. So it should be $24,000 of your money. But look, $46,204.09. That means that $22,204.09 of this you didn't put in. It earned it on top of each other for compounding interest, which I think is pretty neat. Okay. Now, this was an example with ordinary annuity. You could do, and it was also future value, but you can do the same thing for something that you needed a present value for on an ordinary annuity. You just use a different table, okay? Different factors. The process is the same. Same thing for annuity due, whether it be present value or future value. So make sure you're looking at the right table when you're doing calculations, and make sure if your interest is being compounded, if you're making payments that are not on an annual basis, you need to make that adjustment like we did here for the rate and for the period, the number of times that this is happening.